Hello, dear friends, welcome. I feel like I should talk a bit about macroeconomics today. So in this video, I will give you a pretty good overview of some international economics, some other markets beyond FX. I'm trying to basically condense all that complex information into a very brief and concise overview. All right? And I would like to give you a bit of an impression what's going on. Also on a macro level, you have so much noise these days. If you switch on the news, you just get bits of information taken out of context. It all seems very confusing to a lot of people. But thanks God, there are people who, condense things to the most relevant information. And that's what I'm trying to do here. I made use of several sources, such as here. I took these diagrams from Ray Dalio. He made those videos. I recommend you to watch them, how the economic machine works. You can find it on YouTube. Really nice. He breaks it down to the most simple level. And I'm trying to give you here that kind of perspective on the economy across countries, the current situation around the world, etc. Okay. So to make a long story short, remember that Ray Dalio says there are those three main aspects of an economy. Yeah. On the long term, we have like productivity growth. Then on the short term, we have short-term debt cycles, which go up and down. And then we also have long-term debt cycles at the same time, around 75 years on average. And he shows how around the long-term debt cycle we have the short-term movement, and then if you scale out once more, you have the long-term productivity. But he also shows you how historically whole empires grew and fell with those kind of cycles. Yes? And the question is, in what kind of situation are we right now? And I would say let's first look at the economic data, then let's look at some markets. And then we come back to this whole macro view on what's going on. Yes? So, first of all, let's look at the US, of course. What are we talking when we talk about inflation and all that? 7.5%, as we know. Very high inflation, of course. I mean, if you look, it constantly increased. And of course, the stock market's increased as well. We'll come to that in a second. But I mean, so what's going on? Let's start at the very beginning. We are now in a 12-year bull market since the last financial crisis. What happened? Basically, the result of a monetary policy was this extraordinary long and strong bull market. To make a long story short, the central banks, such as the Federal Reserve, decreased interest rates as we have not seen in the last half a century, to zero, even below zero effectively. So what's happening? Basically, to make a long story short, the central banks pumped the whole system up with cash. Because what's the result from decreasing interest rates? Well, to explain it in a very simple manner, if interest rates are low, companies can borrow cash very cheaply. So what happens? Companies sell bonds, all right, at low interest rates. They use that cash to invest, okay, such as producing companies that buy more machines, okay. They increase spending, they invest into projects, they employ more people, so productivity increases, okay. Companies produce more, they sell more, at some point they also increase salaries, even though they never do it at the same rate. But you see, like, decreasing interest rates pumps liquidity into the system. Companies are doing better. Cash is available at lower prices, so to say, because remember, the interest rate is nothing else than the price for money. Yes. They can take on credit, all right? They use that money to invest. Growth comes back, all right? Their income increases. They have more funds to invest. So it's a positive cycle. It has a positive impact on the economy as well. Don't forget, not only do we have these low interest rates, but we also had all the quantitative easing programs on top of that. We had fiscal spending programs. We'll come to that in a second. So on all levels, okay, the economies, especially in the West, got pumped up. All right, so what happens, however, is, and every economist is aware of this, at some point the economy overheats, okay? Price levels at some point increase, all right? So that's where the inflation comes from. And, you know, we see that right now as we speak, okay? So just to put things into perspective, okay, what happened? GDP did well, for example, yeah, in the US. So 5.7% in 2021, unemployment 4%, yeah, so more people get employed. Of course, in the US, we have the situation where the US imports more than it exports. We'll come to that as well. But have a very careful look at this graph. What's going on? Debt increases. And in the case of the US, debt has exceeded $300 trillion. Okay, think about that. Massive debt increase over the last 2 decades. That is the result, and nobody talks about that. Everybody sees how the economy is doing better, how unemployment goes down, how GDP goes up, okay, but they also see how inflation increases and how government debt increases. And what the implications of this are, we will also discuss in a second. Okay, let's also quickly look at the 10-year government bond yield. All right, you see it was kind of ranging, then decreased, and then recently increased towards the 2% level. And of course, you here see the central bank balance sheet as well increasing. So CPI, wages of course increased as well, as I said before. Here you see like beyond $26 per hour now in the US, steady increase in the last years. All right, but the actual substantial shifts in wealth are has to be considered, namely the fact that people who own stocks, okay, people who own parts in a company had massive returns in the last years. Okay, let's also look at Europe, and I really like this tradingeconomics.com website. It's nice, it condenses information, helps you to cut through the noise. Europe also has a similar situation, also has an increase in GDP, like here 4.6%, unemployment somewhat higher, around 70%, but inflation also not as high as in the US, is 5.1%. Still, look at this, government debt, 98% of GDP, so also high, yes. Okay, let's look at the UK. The UK is somewhat in the middle of the US and the EU. Okay, 6.8% GDP, so also increased productivity. Unemployment 4.1%, inflation 5.4%, but they increased the interest rate to 0.5, as many of you know recently. Now let's look at Asia. Okay, you hear so many things about Asia on the news, and it's all noise. Okay, let's cut really through all that noise. Let's look at China. What are we talking about? Growth rate 4%, unemployment 5.1%, inflation only 1.5%, however, interest rate of course 3.7%. So while there's not as much inflation in China, okay, they of course have already a higher interest rate. Just keep in mind, of course, you can't compare everything one-to-one, but this is just to give you a general overview of what's going on. And then also, when we look at Japan, I mean, I have to say, You know, there's a saying, there's economics and Japanese economics, and that's really true. Yeah, sometimes in Japan, many macroeconomic variables can be completely inversed. That has to do with the kairatsu system and other things. But let's just have a look at it. So low growth, yeah, only 1.4%. Unemployment also low, 2.7%. And inflation low, 0.8%. You know, Japan also had deflation. And interest rate negative, 0.1. So very different from the rest. But look at that as well. The 5-year return in the Nikkei 225, almost 44%, but went flat for a long time period. Yeah. Whereas when we look at the 5-year performance of the Chinese index, it's only 8.86%. Okay. Bonds went up as well, but we'll talk about that later. Okay. Now also let's look at Russia. I mean, Russia is still an international powerhouse, let's say, when it comes to the military and influence on other countries. Economically, not so much, but let's take a closer look. Okay, so GDP rate 4.3%, unemployment 4.3%, inflation 8.73% with an interest rate of 8.5%. So we have high inflation, but also high interest rates. Okay. However, look at that, the government debt to GDP ratio is lower, 17.8. So, what's going on in the West? To make a long story short, okay, we are in a situation now where the economy is very overheated, inflation is up, the central banks want to increase interest rates this year multiple times. If they do it, they may be able to slow down inflation, but of course there will be other consequences, such as a decrease in stocks, okay, again an increase in unemployment potentially at the end of it even, okay. So the problem is this, okay, this went on for some time. It prevented a crash of equities as a result of certain developments, such as international conflicts, like potential conflicts such as in the Ukraine right now, or the effects of COVID. But as a footnote, remember that COVID mostly hurt small companies, yeah, the coffee shop in the street was not part of a big chain. But Apple still sold iPhones, yes. Tesla still sold cars. So the big companies actually had an increase of the overall performance, okay? But we'll come to that also. The problem is this here. Eventually, okay, something needs to be done on both sides, the government spending side and the central bank side, namely increasing interest rates, yes, cutting spending by the fiscal policy, restructuring the outstanding debt, okay? So that automatically leads to another type of wealth distribution as well, yeah? Because in the end, for example, taxes need to be increased. So we have, of course, several factors interacting with each other. But there needs to be a period of austerity. Otherwise, what happens, inflation will increase more and more, and the central bank has a mandate to prevent that. Okay, so this will be a big topic for the next 5 to 10 years. Keep that in mind. There are other things I don't want to elaborate so much on, but for example, people have plotted the S&P 500, the stock market, to the yield curve, and they have seen that there tends to be this whipsaw correlation. So people are very concerned that they see now this relationship. While, for example, when you look at the Chinese bonds, the bonds have outperformed the international bond index significantly. Yeah, because what's going on in general? Remember that the US is a so-called twin deficit. The US imports more than it exports, and does it at also by on the basis of debt financing. Now, China is a major buyer of US treasuries and government bonds. You see? So we have a buildup in the international reserves there, whereas there's an imbalance when it comes to imports and exports. Of course, if, for example, interest rates in the US increase, yeah, that can give the dollar some strength again. All right, keep that in mind as well. Okay, so let's look at the some actual markets. Okay, let's start. So we see, of course, here the international, the US stock market, the S&P 500. We had this amazing increase since that stock market V, where the S&P went from like 2,190 2,182 points all the way up to 4,790 points. Okay, so it more than doubled. But recently, as you can see, well, this trend line finally was broken. Okay, this low here was cleared with a pullback and now some kind of trend resumption. You can see possibly we already are in a situation where after the central banks announce what they're going to do, stocks will normalize somewhat. Okay, so when you look at the big V move, okay, which was really a difficult time for example, big funds because they got whipsawed. This is uncommon in the long-term charts, of course. We had the big increase, big bull market in stocks, driven by this monetary policy, driven by money printing, okay, pushing liquidity in the system. So what happens, in the end, all the EBITDAs, the net profits increased, okay, investments increased, spending increased, GDP goes up, unemployment goes down, but debt increases and inflation increases like now. So now we enter the next phase of the markets and the economy where the central banks will try to get inflation to come back down towards a more reasonable level. And of course, after this whole pumping, the market is sensitive. But remember, even if there is a significant correction in stocks, overall, because of that policy, any corrections may look, for example, like a 50% reversal. You know what I mean? Like because markets are so high, even if we have drastic decreases in stocks, on a macro level, the overall stock market still traded around high levels. You see what I mean? In relative terms. So one could say that because of the monetary policy, we will not see like a complete crash down to historic levels like we saw before, okay, in the markets. So let's look through some current charts. So the volatility index is increasing already, 29.18. Gold, as expected, is going up, okay, and looks bullish, of course. When you look at the day chart, we had this flag pattern going on for a long time, which now gets broken to the upside, as you can see. Silver is kind of following this whole movement. Oil, as we said before, we're fundamentally bullish, 93.63 here in the WTI. Bullish, went up as expected, can go up further even, yeah. Now, as we know better, as a footnote, cryptos, we had here day chart of Bitcoin. Okay, we also had quite good predictions in the macro videos, okay? So after the correction, a pullback up, a tech of the high, and then the correction down. Not all the way down to the 30K level, but did a pullback before. Of course, it can get stuck in a range. It kind of remains long-term bullish, but these are multi-year considerations. Of course, here we are more concentrated on short-term moves. It can, of course, also consolidate. But 48K, for example, seems to be like a reasonable medium-term target. However, what I want to say is, like, people thought that Bitcoin would be quite uncorrelated to stocks. That's not the case. We see quite some correlation to stocks, right? Doesn't seem to be a safe haven, neither the other cryptocurrencies. But as we know better than anyone, it's all about this, of course, yeah? This is a long-term chart of euro-dollar, day chart today. It's all about the proven games, okay? Dumb money comes in, the dumb money buys, the algos push it down, dollar gets stronger. Dumb money comes in, boom, dollar gets stronger, okay? This, as I've documented it for several years now, is what's going on. That's what matters. So if you have the combination of, let's say, fundamentals pointing towards the stronger dollar because of increased interest rates, and then you have the dumb money going on the long side, of course your dollar will go down again. Yes, that's why we see now, after they cleaned this moving average and the high, we see that there's some kind of trend resumption going on against those new longies, okay, the ones who try to buy euro dollar thinking that the dollar would lose in value, which doesn't make any sense. Understand? So that's why actually the dollar can get stronger again or get stuck at some consolidation, okay? That's in the end what really matters. Of course, the international bond index on a 5-year level came down. All right, so that means that basically the period which is about to come, and which either already started or is going to start soon, will be a period of more turbulence, okay? This can be even amplified if there would be an international conflict such as in Ukraine. But the base case is not a full-blown conflict in Ukraine, all right? It's less likely that Russia will go for a complete invasion or anything. The medium base case would be, for example, that the eastern region, such as Donbass, will try to become part of Russia, similar to how it was in Crimea, rather than a full-blown conflict where, you know, Ukraine fights against Russia outright. However, it doesn't even matter. Remember, like, it's just about some stimulus which comes. It doesn't even matter what kind of stimulus it is, but things can quickly turn, okay? On an economic level, the central banks basically will need to increase the interest rates. There's not much choice. Now, everything has been done on all fronts from all organizations to prevent a big market downturn since the last financial crisis. That has worked, but now we see the consequences, because what happens? Go to the supermarket, compare the prices you paid today to, let's say, 4 years ago. It's amazing how prices increased. Across the board, whether it's groceries, whether it's energy, okay, all the prices have increased. Of course, wages also increased to some degree, but there's always also the lack of wage increases compared to the other factors. So, to make a long story short, we have an increased inequality in Western societies. It was already bad before, but it has been amplified in the last years, because people who had stocks, who had assets, who owned, got massive increases in the value of their assets, but then a large part of society who is employed doesn't really benefit from these developments. They may have some increase in wages, but they get offset by the increased inflation, you see? Of course, what happened also is borrowers were preferred because they could borrow at very cheap rates. Now, if interest rates get increased, that changes again. The problem is that people who save money get punished by the inflation. The money they saved will decrease in real terms because of an increase in price levels and a decrease in their purchasing power. You see? So there will be consequences for societies in the West. And inequality is already very high, and it will increase. The problem is, once the austerity programs are starting and are to be implemented, there can be social turmoil. Ray Dalio has explained how the situation right now looks even similar to the situation in 1935, where we had Hitler coming to power. Because, you know, when these things happen, as I've shown, large parts of society suddenly are open for to radical leaders. That's always dangerous. And out of that, international conflicts can arise even. So I'm not a pessimist or anything, but I want to make you aware, after this decade of growth and after the stock market broke out of this consolidation which was there beforehand, after all the increases in spending, investments, expansion, production, salaries, employment, now we will need to deal with the shadow sides of all these developments. And where this will take us remains to be seen. That's difficult to predict. Now, so to make a long story short, be aware of these developments. Be very, very aware how any numbers related to inflation will impact the markets. Okay, these days the markets are very sensitive to things such as CPI. The central banks are watching those numbers right now with a very close eye, of course. But on a macro level, be aware in what kind of situation we are. For example, it doesn't really make sense to buy large stocks at this point, is it? Because what you're doing is you're paying already implicitly a premium for quite a high degree of risk that there will be a correction. And if there's a correction, people underestimate how high the correlation is among stocks and other asset classes, which is a result, by the way, also of algo trading and arbitrage. People underestimate that even if you find a good company and you buy stocks in that company and everything looks good, and even this company performs well in terms of net profits and expansion and whatnot, those market factors can easily push prices down for several years. They can make sure prices stay in a consolidation for several years. So in a way, the party is over. Okay, so be aware of that. Secondly, be aware that while crypto seems to be a good long-term investment, the correlation so far towards those other big markets is rather high. So it's not that you can, just jump into another asset class. Okay? Of course, what happens is Forex will become even hotter than ever. Because if one realizes those facts, we'll see that trading Forex seems to be very, very attractive. But, of course, you will need to understand what you're doing by understanding the market manipulation in Forex. So that means a few people who understand Forex very well will do very well with it, while most people still will not, because they don't understand the market structure as it's shown on this channel. Yeah. So after the big increase in the crypto markets, okay, in the last 10 years, after the big increase in the stock markets of the last 10 years, after the increase in GDP across the board, now we can enter a different phase. Asset classes will continue to be rather correlated. There is a high degree of market risk right now. Okay, there's also a high degree of systematic risk. On a macroeconomic level, the central bank will not only change the interest rates, they will play with the expectations of the interest rate and the expectations of inflation. That's what many people don't know. That's some of the things they look at with the hawk's eye, because the expectations, the inflation expectations, basically are one of the most relevant factors in this context. And while on the macro scale we have seen in the last decades how globalization increased, international trade increased, okay, there's been more and more international trade across countries. We also see the massive levels in debt, especially in the West, especially in the United States of America. And this can't go on forever without the central bank being forced to do something about inflation while trying to keep the whole system from imploding. All of this will turn into another kind of wealth distribution, but let's look at this for a second from the micro level. Yeah, what changed already fundamentally in the US, for example? Things can look dark. If you're a student, many students who graduate these days, they actually come to the employment market with debt. They have personal debt, 50K, 100K, 200K, 300K, right? Then they like to take on credit while they're working, to buy houses on credit, etc. So many people spend a large part of their life, many decades, to get rid of the debt they took on in order to have a degree, have a job, or have a house, buy assets on credit, etc. That also leads to a high degree of income inequality and general wealth inequality in society. Okay? Apart from the fact that we have a lot of short-term contracts, we have less and less long-term employment. Okay, companies are less and less ready to employ people for the long run. The economy is becoming more and more dynamic. It's changing completely in nature. It's more and more virtual. It's more and more online, more and more service-based, more and more technology dependent. So we have a lot of fundamental changes for society for the next decades. And again, people who have assets and are able to benefit from certain developments have a higher chance of doing so than, let's say, the average citizen on the street, or employed people who try to build up savings and, you know, who try to have a high standard of living. So hopefully the governments will realize all these things and implement certain measures which will allow for fairer degrees of income distribution. In what ways that is done. Whether they have to do so via taxes or, you know, in other ways, that remains to be seen. It's a complex topic as well. And obviously it's not easy at all, because the last thing the governments want to do is to increase the debt outstanding, okay, because if there is no effort to restructure that debt or parts of it, it could even be that government bonds go down in their rating, yeah? We've seen it before. Of course, nobody's interested in any kind of government bond defaults, but, I mean, you can only roll the debt so much, yes? Either way, whatever will happen in the future in the next decades, yeah, whether there maybe is a completely new technology which balances some of those macroeconomic factors, normally, you know, the economy needs time to adjust, and we're talking about a lag of several years even. That means in the short term, people will be affected as described. But to make a long story short, the good part is, the one thing which will not change is the market causality. I can tell you that. The smart money algos will continue to move prices against the dumb money positions. They will still go down. They will still go for the stop accumulations. And right now we see actually how the crypto markets get more similar to Forex, not the other way around. Because guess what? In cryptos, we now have an increase in algo trading as well. We'll say similar games are played. And I tell you, this nature of price action will increase also in the next years. So, Forex will become even more interesting, but you need to know what you're doing. You need to understand the market causality. And as you can see, it makes sense now to actually invest some time into understanding it. But this is not supposed to be a sales pitch or anything. And I just want to give you the bird's eye view, so to speak. Anyways, I hope for the best. I hope there will be no war in Ukraine. I hope that as soon as possible the number of wars around the world continues to decrease. I hope that societies will still have some equality, that governments have the backbone to implement redistribution programs if necessary, to also make sure there is social peace and to prevent a situation where a low number of individuals owns almost all of the assets, that it doesn't get worse as it already is. I hope that no radical leaders come to power and try to provoke new conflicts. But please be aware of the things I showed you within this video. I tried to keep it short, but I exceeded half an hour. I'm sorry for that. Okay, use a bit of common sense. Understand what's going on. Do not think that because stocks went up for the last decade, this needs to continue. There can be corrections, all right? We see already the first signs of changes in the overall modes. And even if stocks, increase and, the pumping continues and all that, understand how all of this will impact bonds, okay, the other asset classes. And in Forex, whenever you see, like for example now in Euro-Dollar, which is coming down as we speak, going for the stops, that the money gets lured on the wrong side, it's not difficult to predict what will happen next. Okay, and do not ignore all these facts. Okay, do not just think that because if you're a young guy or girl and you just saw the last few years and you think that's how the world is, that everything must go up, stocks must go up, cryptos must go up, even some bonds must go up, and real estate goes up. And no, markets can change. Okay, look at the historic data. Markets can move both ways. It doesn't go one way only. Nobody will warn you. Okay, and of course in this situation now we have a lot of popular people, big hedge fund managers who say that the market is bearish 3, 4, 5 years ago because they thought on average it should be a 7-year bull market. They didn't expect that the central banks would really do what they did in the end, to do anything to pump liquidity into the system, no matter what, but that's what they did. However, now we see that at this point things need to be implemented, whether people want it or not. Anyways, we will see how all this will play out, but I hope you like this little overview. Stay safe. Goodbye.